You shouldn't buy the dip blindly. Most traders think they're buying at a discount, but they're actually catching a falling knife. I'm Dennis Wilborn. I built the AutoPilot Trading System to help busy people trade with clear, rule-based confirmation instead of guessing. In this video, I'll show you one confirmation signal I wait for before I buy the dip, and why skipping it turns a smart idea into unnecessary risk. You ready? Let's go. You see this big dip up there? Looks like the perfect time to buy again. Stocks are cheaper, so you just jump in and wait for the profits to come rolling in. Easy money, right? Wrong, because sometimes instead of bouncing back, the price does this. That's the fastest way to turn a smart buy into a dumb mistake. So today, we're talking about how to buy the dip the right way, and most importantly, how to avoid getting crushed in the process. Now I get it. Buying the dip sounds like a cheat code for making money. Matter of fact, easy money. But here's the thing about it. Not all dips are created equal. And this is where most traders go wrong. You know, there's this meme that's floating around that says, I don't always buy the dip, but when I do, my stock keeps on dipping. You know, what a sad commentary, right? And I don't want that to happen to you. So let's check out the mistakes, and then we'll jump into what it looks like on the chart to basically buy the dip the right way. Okay, there's three major mistakes that traders make when they're trying to buy the dip. First is buying too early. A lot of people buy the first red candle that shows up as soon as it starts to pull back, thinking they're getting a discount, and they just basically throw caution to the wind and buy. But if a stock is still falling, guess what? You're just throwing money into the fire. What looks like a great opportunity soon turns into just a dead cat bounce. And then you're stuck trying to catch a falling knife. Trust me, it's going to hurt. I've been trading for over 30 years, and I've noticed something that buying the first three dips of an uptrend usually is a good play, smart play. But when you try to get in on the fourth, the fifth, the sixth dip, the odds are against you. They're low probability trades because, according to mistake number two, you're ignoring momentum, because what's happened, much like an airplane is trying to climb to a higher altitude and zoom up there, but it doesn't have enough airspeed, it's going to stall and crash, just like your stock will do. The next one's my particular pet peeve: trying to trade without a solid plan. Like I said, this is a big one. And a lot of people just say, hey, my strategy is I'm going to buy the dip. And they think that's the strategy. But that's not a plan. That's just gambling. You know, roll the dice, see how you're going to do. And it's a great way to just start losing money if you don't have a stop loss in place and an exit strategy, or a reason to buy beyond, oh, it's cheap now, I can get it. You're setting yourself up for disaster. But there's good news, and it's coming right now, because I'm going to show you how do you buy the dip the right way. All right, now that you've seen what not to do in buying a dip, now it's time to learn the right way to buy the dip, the way that will potentially actually make you some money. Step number one, and step number one is very crucial. One, I want to look for a strong ETF or stock that has already formed a reversal bottom after a sustained downtrend of several weeks, months, or even years in some cases. And the first, second, and third dip after the reversals are your best bet. Anything after that, you're likely buying into a weakened trend. In other words, it's like the airplane. It's having a hard struggle getting up to a higher altitude because the momentum is melting off. You know, I do cover all of this in my book, Trade Your Way to Freedom. My 4 setups and triggers that I use to get into all my trades, and they match this perfectly. So let's take a look at those first 3 setups. This is a chart of NVIDIA, going back to 2021, where we get this nice little pullback, the first part of 2021, and then that was a pullback several weeks long that attempts to rally, pulls back, and then continues to rally from there. So this is my rally. And the reason that I know I'm probably into a new, stronger uptrend is because one, I put in a higher low right here, and I've broken out above this high, higher high. So this pullback right here is dip number one. Dip number two is up here. This little pullback right here doesn't count as a dip because I didn't break out above the high here. This up here counts as dip number three. And see how a dip can actually last several days / weeks? And what is required of us is to both be patient and be prepared for what's potentially going to happen next. Step two is to wait for confirmation. What does that mean? Wait for confirmation that we're actually going to bounce in order to get into the potential trade. Here's the perfect example on this is dip number one. And as you can see, we've pulled back, and a couple of things are going on here. Is one, my confirmation is I have a flag down. You know, a lot of times people look at a flag being a dip, but in a higher low off of a strong level of support. That's the 200-day moving average. Then I like to use one of my favorite triggers is, of course, a bullish engulfing of that candlestick. So I have a bullish engulfing candlestick, and then I break back above the 8-day moving average. So there's my trigger to get in. So you may have probably been wondering, is that applicable to each one of the dips that you get a good setup like this? And the answer to that is basically yes. Notice we've had a pullback into a strong level of support, stops on number one, broke above the 8. Pull back to a strong level of support on dip number two, broke above the 8. Pull back on a strong level of past support from on dip 3, break above the 8. And then even on the fourth dip, which basically was when things were running out of gas, we basically still got actually a little bit more of a wonky move back above the 8. The 8 held, but then we broke up. As I mentioned earlier, and take a look at this. When I made this high, we talked about that momentum coming out. Notice, as I made that high, my momentum was starting already to fall from the sky. And when the momentum starts to do that, going higher, well, it works for a little bit, will not work for long, and pretty soon it's going and going belly up and nose to the ground. Not a very pleasant sight. I'm not going to go any further until we talk about risk management. Whenever you basically enter a trade like this is a daily chart, I can put my risk down below this swing low. Now, from here, and so if I put my stop down below this swing low here, how much am I risking? Well, just get a real quick number here. The low there, that's about 5 to 7%. Not too bad. It's within the realm of my 5 to 8% stop loss that I carry on my AutoPilot trading service. But then where does it go before it starts its pullback again? Well, that run there turned out to be 46%. The run I did that happened over here from the 8-day ran up, how far? 19%. And then run number 3 ran up from approximately, we'll call it right there. And this ran up before it did pullback number 4, another 56%. So you see, if you catch the move early and you can jump on board those first 3 dips, they can compound out very nicely. Okay, now you know what to look for determining whether or not you're buying the dip at the right time or the wrong time. Just imagine if you start practicing this, how to buy the dip the right way. Think about what you can do as becoming a master trader. It'll be phenomenal. and I'm here to root you on.